Although it's obvious that you can make money in the stock market when stocks rise in price, you can also make money when prices decline. With short selling, you're wishing for bad news. The more the stock drops in price, the more money you make. Short selling involves borrowing stock from your broker and selling it. Then, if the stock price goes down, you buy it back and return it to your broker. You make a profit by buying it back for less than you sold it. Beware, however, that if the price of the stock goes up, you have to buy it back at a higher price. You lose. In effect, selling short lets you reverse the order of buying and selling. That is, when you invest in a stock, the goal is to buy low and later sell high. With short selling, the goal is to sell high and later buy low. Short selling isn't necessarily free or even cheap. Because you borrowed someone's stock and sold it, you not only have to replace it later, you also have to repay any dividends that were paid during the period for which the broker was without the stock. Also, to protect itself from short sellers who might lose the money, the broker keeps the proceeds from the short sale until it gets its stock back. To provide the brokerage firm with a further guarantee that the short seller will be able to repurchase the stock in the future, the short seller must put up some collateral, referred to as margin requirement, during the period of the short sale. Let's suppose you feel strongly that Amazon's stock price is about to fall from its present level of $1,448.69 per share, and you want to make money off Amazon's misfortune. First, you call your broker and sell 100 shares of Amazon short. The proceeds of $144,869 are credited to your account, although you can't withdraw those funds. Your broker has a 50% margin requirement, which means you must have an additional $72,434.50 in cash or securities in your account to serve as collateral. Most short sellers keep treasury bills or notes in their account for this purpose. Now let's assume that Amazon stock drops to $1,000 per share, and you decide it's time to buy. You call your broker to purchase 100 shares of Amazon stock for a total cost of $100,000. Thus, you make $44,869 on your short sale by selling high, $1,448.69 per share, and later buying low, $1,000 per share. Remember, when you sell short, you also have to cover any dividends that occurred during the period the broker was without the stock. Thus, your profits are actually equal to the initial price less the total ending price, the dividends. Of course, if Amazon's price goes up, you will lose money because you will have to buy back the stock. Thus, if Amazon stock goes up to $2,000 per share, you'd lose $55,131 on your short sale. In addition to having to cover any dividends that occurred during the period the stock was sold short, you'd also have to listen to your broker laugh when you give back the more expensive stock. In this case, you'd have sold $1,448.69 per share and later bought high at $2,000 per share. Given the fact that the long-term trend of the stock market is upward, selling short is extremely risky and isn't something most people should consider. This lesson was pulled from Personal Finance, Turning Money into Wealth by Arthur J. Keown, a textbook that was part of one of many finance courses I took in college. If you found this episode helpful, please give it the thumbs up and share it with your friends. If you feel inclined, please like us on Facebook, subscribe to our YouTube channel, follow us on Twitter and Instagram, and if you really want to, subscribe to Gennecho's weekly newsletter. We will give you all sorts of advice, tips, and strategies to all things finance and investing. Just click the link below and enter your name and email in the form provided. Thank you so much for watching and have a great day.